Hi, I'm Patrick Ritchie, and in this webinar, we're going to talk about comparing closing costs by credit scores. So the FICO credit scores make a significant difference in the cost of a mortgage. And as you'll see as we go through the module, it's going to affect the interest rate and the cost to get a certain interest rate, and of course, what the monthly payments would be. Now remember, the FICO score is the only credit score used for mortgages. A lot of times consumers will get a credit score that's not used by maybe any bank at all for any lending. But when it comes to mortgages, there is only one credit score that we use. It's been that way since the end of 1994, beginning of 95, and it is the FICO score. So that's the one. If a consumer wants to check their credit score, they need to make sure that they're checking their FICO score. The other ones don't matter. So for FHA, the ideal score range is going to be over a 720. So 720 plus is ideal to get the best terms, to have the lowest closing costs. And when I say closing costs, I'm referring to buying the rate down to get a better interest rate versus just whatever the par rate is for that day, which is the rate that somebody would get without paying more to get that rate. And for conventional, the ideal FICO range is going to be 740 or above, all the way up to, say, the 850 point. And pretty much, if somebody is 740 or above, they're always going to get the best terms. Now, in some situations, like on a jumbo loan or a specialty portfolio product, you might see a benefit if somebody's over a 760, maybe over a 780. But in general, for your Fannie Mae and Freddie Mac conventionals, if they have at least a 740 for their mid FICO score, they're going to get the best terms available. So what is the difference in being at the opposite end of the spectrum? So now we're going to the lowest scores that somebody can have, and what's going to be that range. Keep in mind, this is just an educational example. This is not an offer to extend credit. So we're just using these as samples for learning purposes. And the rates that I'm using are from December 1st, 2014. And this is an average of a few different rates that were available that day. So is it possible somebody could have gotten a better rate? Yes. Is it possible somebody could have gotten a worse rate than what's in the example? Absolutely. But this is just an average for an educational purpose. And we're going to use $200,000 as the loan amount. We're just going to use an even $200,000. Now, granted, if you're putting 3.5% down on FHA and 5% down on conventional, it's not going to come out to $200,000. Plus, with FHA, you're going to have that upfront mortgage insurance premium, so it's not going to ever equal. But for simplicity's sake, I am just going to use $200,000 even for all the numbers that I'm using in this module. So with FHA, you got 3.5% down, and that's going to go down to 580. If you look in the HUD 4155, which is the guidebook for the FHA loan program, you'll see that with 3.5% down, which is the minimum down for an FHA loan, you can go down to a 580. Now you put more money down, at that point you can probably, I think it says 500. So it's going to change based on somebody putting more money down. Now a lot of times you will have overlays where some lenders may say, well, we'll only go to 600 or we'll go to 620 or we'll go to 640. And you get under a certain level and you're going to probably have more requirements in terms of definitely having verifiable housing history, maybe having reserves, stuff of that nature. But the guideline is 580 with 3.5% down on FHA. And in a conventional, Fannie Mae will go down to 620. But if somebody were to go with Freddie Mac instead, they could potentially go under a 620. Once again, you run into whatever the overlay for a lender may be, whatever their guidelines are on top of the actual guidelines. But for Fannie Mae, which is more popular than Freddie Mac, 620 is going to be that minimum FICO score. So the par rate, which is the rate that somebody would get without paying to get that rate. So they're not paying more to get that rate. We're going to call that the par rate. For FHA on December 1st of 2014, averages out to 3.75 with a 720 plus FICO score. Now the worst par rate for FHA on December 1st was 4.625 with a 619 or less FICO score. So they're not paying anything more to get that 4.625, but keep in mind, somebody over 720, they're getting 3.75. So obviously you can see there is a direct correlation in terms of what somebody's going to pay for their interest rate. Now, could someone with a 580 to 619 FICO score get that 3.75% interest rate that the person over 720 is getting? Yeah, of course. Yeah, they can do that, but at a cost. It's going to cost them to do that, and that's where you get into paying discount points, which is of course going to add to the closing costs. And we've got $8,321. So somebody in that 580 to 619 range for their FICO score on a $200,000 loan amount for that day's pricing, to get that 3.75, it's going to cost them $8,321. Now, keep in mind, this could be different from lender to lender. It's never going to be exact at every single lender because every single lender's potentially getting different pricing. They're doing things a little bit different, but this is a ballpark figure. This is to kind of give you an idea of what that cost is likely to be close to. So is it worth it? Is it worth it for me to spend over $8,000 to get 3.75? I mean, obviously having a lower payment is nice, but that's a lot of money to be coming in with, and a lot of FHA borrowers probably aren't going to have that kind of money. So is it worth it? Well, we have to figure out what the break-even point is. So if we divide that $8,321 by the monthly savings, the difference between paying 4.625% on 200,000 and paying 3.75% on 200,000, it's a difference of $102.05. So if we divide that into the cost to get the 3.75, to get that monthly savings, while we are saving on a monthly basis, we have a large upfront cost. So by dividing the savings into the cost, we get a break-even point. And the break-even point is going to be roughly 82 months or 6 years and 10 months. So that's a pretty long break-even point. And you have to kind of think in terms of looking into that proverbial crystal ball of what is life going to be looking like in 6 years and 10 months. And a lot of people aren't going to be able to look that far in advance and really know. They might say, well, this is the house I'm going to stay in, or I'm only planning on staying here for 5 years. Well, if you're only going to stay there for 5 years, you would not want to pay to buy the rate down, at least not to that extent, because you're not going to be there long enough to recoup the money. Now, maybe there's other necessities in terms of, I got to keep my payment lower in order to qualify. So that's a possibility. But if I'm just looking at the big picture in terms of where am I going to come out ahead, I'm not going to come out ahead until after 6 years and 10 months in that scenario. So the par rate on December 1st for a conventional was averaging out to about 4.25 with a 740 plus FICO score. So the worst par rate was at 5%, and that was being 639 down to 620. And so that's, once again, not paying more to get the better rate. That's 5%. There was no discount point to get 5% if you were under a 639 FICO score. So could somebody get that 4.25 if they're in the range of 620 to 639 for their FICO score? And yes, as you already know, at a cost. So it's going to cost them, just like it did on the FHA loan, it's going to cost them money on the conventional loan as well in order to get that lower interest rate with that FICO score. It's going to cost $7,439. Now, we have a higher FICO score range compared to the example with FHA, but this is still a lot of money for somebody to pay to ultimately try to save per month. But let's look at the break-even point. So if I divide the cost to get the savings by the actual monthly savings of $89.76, that's what's going to be the difference in the interest rate per month. It's going to give me a break-even point pretty close to what we saw with the FHA. It's going to be 83 months or 6 years and 11 months. Once again, it's a long time. Trying to predict whether or not you're going to still be in that mortgage at that period of time is hard. You may not even be in that house. It may be a situation where somebody refinances to pull cash out. Who knows? But it's hard to know for sure that you're going to be in that situation where you actually would benefit overall. And I've had clients in the past who have bought the rate down significantly only to sell the property, only to refinance the property. It's really hard to predict what life is going to throw at you. It could be a job transfer. You could be happily married today, but unhappily divorced tomorrow. You never know. So you have to kind of think about it in terms of You are laying that money out there into the future, and maybe it'll be a benefit, maybe it won't. Yeah, there's the monthly savings, but when you think about the big picture, am I really coming out ahead? So is it worth it to buy the rate down in these situations? It's going to vary for everybody in terms of, what it is that they're trying to achieve. As I said earlier, they may have other reasons other than just an overall savings. It may be about trying to get that lower monthly payment to make it more comfortable in the long run for the life of the loan. And if you get beyond the break-even point, you do save money. That's the nice thing is, if you do reach that break-even point, you will save money, and it becomes a benefit at that point. So obviously there's a large sunk cost at the beginning, but if you get past that break-even point at that point in time, you are essentially saving money, and it was worth it. So what about somebody who's slightly less than excellent on the FICO score? How are we going to classify that? Well, for FHA, we're going to call it a 680 to 719 because it's only slightly higher. We were at 3.75 if we were over 720. So if we're just slightly under that into this next tier below at 680 to 719, we're at 3.875. It's not much of a difference. And from a monthly standpoint, we're only talking $14.24 per month. So it's not that much of a difference, but over 360 months, over the 30-year amortization, of course, that's going to add up. But to buy it down from being at 3.875% at par to now buy it down to 3.75, the cost for December 1st, 2014 was $975. So if I divide the savings, the 14 and some change, into the 975, it gives me 68 months or 5 years and 8 months as my break-even point. You already know the story. We don't know what the future holds. We have to wait for that time to pass to see if we're actually going to come out ahead. But the point is, you got to know what your break-even point is to make sure that it's an advantage. Now, there could be some tax advantages to doing it. So definitely talk to your tax person about whether or not it makes sense to do it for that year that you're buying it. There's different ways to approach it, but there could be some tax savings in doing it by paying to buy the rate down. So talk to your tax professional about how that would apply to you and how you would want to approach it. And that might show you some different things that, we're not going to talk about here today because obviously everybody's tax situation is different, but that is another possibility. Now for conventional, we're going to say just slightly less than excellent is 680 to 739. And if we were at perfect score, 740 and above was 4.25, we're at 4.375 for just below excellent. And this is still a good credit score, don't get me wrong, but it's going to be a little bit more, and the difference is pretty close to FHA. Anyway, it's $14.69 per month more than the 740 plus FICO score range. So not much of a difference. And the buy down, a little bit more than what we saw in FHA in that previous example, but to get it down to 4.25, it's going to be $1,379 to buy it down, which gives us a break-even point of 94 months or 7 years and 10 months. So another thing to consider, we've talked about the time, we've talked about the potential tax benefit, but also, would it be better to take that money and apply it to a higher rate credit card? Something like that. Would it be better to pay off the car? Would it be better to pay off student loans? I don't know. It's going to vary from case to case, but if that money is there, would it be better to maybe put more money down? You have to look at it from the standpoint of what is in my best interest to do this, because what am I doing? I'm locking that money away. I'm not getting that money back. I'm putting it on the table. It's gone. I only get the benefit if I stay in that specific mortgage. So lower credit scores result in higher rates and costs to get those lower interest rates if somebody wants a lower interest rate. So there's definitely a big issue for people who have lower FICO scores compared to people who have excellent FICO scores or just below excellent FICO scores. So it costs us money if our scores are not in the best shape that they possibly can be, which shows us that it's really a good idea to review that credit before it's time to get a mortgage. If I know I'm going to be getting a mortgage in the next 6 months, I should be looking at that to make sure it's in its best possible shape in advance. Don't wait till the last minute. And even homeowners insurance can be more money if somebody has a lower FICO score. So Some insurance companies may consider the FICO score, some may not, but that's going to add to the closing costs. And then, of course, it's going to add to the monthly amount that they're going to pay into escrow if they have an escrow account for their taxes and insurance. So it's going to cost them more for the insurance potentially. So that's something to consider as well. And for a conventional loan, it's going to factor into what their mortgage insurance cost is going to be. How much they're putting down, what their FICO score is. Those are the two main variables. So the lower the FICO score, the higher the mortgage insurance is going to be. Now, that's not a closing cost, but that is certainly going to impact their monthly payment. And of course, we all want to have the lowest monthly payment that we possibly can, but we'll talk more about that in a different module. So that's a whole different issue within itself, but there is a big impact there with that FICO score. So join us next time. And one thing I wanted to point out on the mortgage insurance on FHA, it doesn't matter what the FICO score is. It's the same monthly mortgage insurance premium, which actually is the annual mortgage insurance premium, even though it's paid on a monthly basis. That's going to be the same. It's 1.35 currently, and that's going to be the same regardless of the FICO score. So on FHA, there's no influence anyway. But join us next time. If you want to learn more about credit, go to creditliteracyproject.com, and I hope this was beneficial.